All right, let's take a look at futures this morning on the final trading week of the year. We've got today and tomorrow, kids, and that's it. The Dow is down 63 points. NASDAQ is up by 33. S&P is down by 1 point. The Dow scoring its 6th record close this month. That was last night. Take a look at stocks for the year. It has been quite a year, despite some of the really bearish predictions that we had. Remember the recession talk? All that recession talk? Well, we haven't hit it yet. And look at this. The Dow for the year up 13%. The NASDAQ up 44% for the year. S&P up 24% for the year. Joining me now, TJM Institutional Services Director James Iuorio. James, it's great to see you. I mean, look, I'm not going to complain. I think it's fabulous that the markets have had the year that they had. We need some good news. We were just talking about that in the commercial break. What do you make of the year that we've had, and more importantly, what's coming for 2024?
So we have to realize that the most of the move has been since October, and that's when the market really started to price in serious eases. The markets like cheap money, and they think cheap money is coming in 2024. Right now, the Fed funds futures curve is pricing in 160 basis points of easing in 2024, including the first ease in March. That seems to be what the stock market likes. But I will caution that historically, to go from a tightening cycle to an easing cycle is usually between 3 and 7 months. But usually, the stock market kind of forces the issue. The Fed talking about easing is different than the Fed easing. And usually there's one solid plunge in the stock market, and then the Fed comes to their senses and begin easing. And I still think that's what's going to happen. I'm somewhat of a bull for 2024. Right now, options are cheap. You can hedge your portfolio. But I do think there could be a good-sized dip in the first quarter. So
I want to bring John Lonsky to this. But so the question's when? Are you willing to kind of make that prediction, or too early?
No, but I will say this, is that options right now, options volatility is at about 13%. Historically, it's 19, meaning it's cheap to hedge your portfolio. Yeah. So I think right now is the perfect time to hedge your portfolio.
Okay, well, that's technical, but John, go ahead, jump in.
Yeah, James, I'm somewhat concerned about the fact that Mr. Market seems to be saying, don't worry, be happy. Not only do you have this equity rally, you're looking at very thin spreads for junk bonds. That means there's perceived as being a very low probability of weak companies coming into financial difficulty. The VIX index is historically low. It's another sign that markets are very confident. And I just can't help but think that early this year there's going to be a great deal of profit taking, and that's when you're going to be hit with this drop in the market value of common equity. The market may have gotten ahead of itself. I think the market is overlooking the reason why the Fed might be cutting interest rates by nearly 2 percentage points is because we are going to have a much softer labor market and a much slower rate of growth for consumer spending.
So I'm so glad when you said soft, you use it in the labor market and not the landing nonsense that everyone else is doing. Thank you for that. But just to put that in perspective, what you said, at the beginning of 2023, 85% of the economists that were surveyed said we were going into a recession in 2023. They were all wrong. Now it's only 30% of economists think we're going into a recession in 2024. They're going to be the 70% is going to be all wrong again. I'm alone on Recession Island. I think the labor market is going to soften. That's where we're going to see it first. Commercial real estate, labor market. And I don't think the Fed is not going to be pushed into the first ease until they start to see the burning timbers falling from the ceiling. And I believe that is going to happen. And then all of a sudden it'll be rinse, wash, repeat, where the Fed comes back in with free money. Federal government will continue doing what they're doing, which is spending.
You and I started off this segment. We started off this segment on such a good footing. I don't know. You're hurting me right now. I mean, come on, James. This is killing me off the Christmas holiday. Tiana, go ahead, jump in.
And I want to just ask about the movement in the bond market this year, what the Fed is saying versus what the markets have perceived. Look, in October, we sort of heard the Fed take this line with they don't need to go much higher because the bond market was doing the work for them, right, pushing the 10-year to like 5%. Then you have the Fed now saying, oh, we're going to have 7 interest rate cuts next year, despite the Fed only saying they project about 3. What do you think why is there this disconnect between what they say explicitly and what the Treasury's futures are perceiving?
Because the market has come to the realization that the Fed uses the rhetoric as a tool. When we started to open up the Fed to more transparency back 7, 8 years ago, everyone thought that was going to be a great idea. It's not a great idea because the words they say aren't just measured. They're said to explicitly get a response from the market. The market knows that. Now, the market's not been right. Over 2023, the market kept saying, yeah, they're going to ease soon, they're going to ease soon, and they've been wrong the entire time. So if you asked me this question a year ago, I always side with the market usually, but they have been wrong. So I do think what the market is telling us right now, that yes, the Fed is going to easing. Yes, the Fed is either lying or they don't understand that things are going to get rough relatively quickly. The move in the long end is interesting, too. I think part of that was a profit-taking move. I'm talking about the move from 5.10 down to 4.30 or whatever the 10-year went. I think a lot of that was profit-taking. There have just been people stomping on bond prices for several years, and they had to get out of those shorts. So I still think long-end rates may stay high, mostly because the federal government has to meet their funding needs and are going to eventually have to start selling long-end bonds, even though they got scared because the auctions didn't go very well the last couple of months.
James Iuorio, it's great to see you as always. I think.
Good to see you.
I'm on the fence about that. But no, it's
going to be a Happy New Year either way. Happy New Year to you.
Happy New Year, James. All right. Thank you so much. Appreciate it.